Hi, and welcome. My name is Casey Boland. I'm a wealth advisor and partner with HCM Wealth Advisors. I'm joined today by Doug Johnson, who is our senior investment strategist and partner with HCM Wealth Advisors. Welcome to our monthly webinar. If you would like to ask a question, please go to the bottom of your screen and click on Q&A, and there you'll have an opportunity to submit your question, and we'll do our best to answer at the end of our webinar. And Doug, certainly we can't have a meeting without some level of discussion about COVID. So the picture that is on my screen is from an art project that my wife, Rochelle, made using printmaking. It's a process involving transferring images from a matrix onto another surface. And you do this a couple times until you come up with the final project that you see on your screen. She made this in the spring of 2020, just as COVID was spreading in the US. The title, "This Too Shall Pass." It depicts the COVID virus in a woman, Rochelle's mom, holding an umbrella. Her mom always had the strength to see the sun shining through, no matter the obstacle. Enjoy. There's a wonderful quote listed by the picture from Helen Keller. The word hope, it's the perfect word for 2021 as vaccinations are rolled out. Okay, Doug, how about that segue to give us an update on COVID and what that means to the economy?
Yeah, thank you, Casey, for the introduction, and welcome to the webinar series. If you've tuned into any of our previous webinars or listened to any of our communication over the past few months, you've heard us talk a lot about the reflation trade and the idea that we are going to see economic growth accelerate over the coming months through the end of the year. And part of the thesis, or part of the reason around that thesis has to do with the idea of vaccinations increasing. Now, there's a few charts on here. Let me pull up my laser pointer real quick. So the left side here denotes the United States. The right side denotes the United Kingdom. So why these two countries? Well, both have very robust medical systems and have had the ability to distribute the vaccine on a widespread basis and on a very efficient basis. So as you look at these numbers, these are vaccines distributed, and the top line here denotes the combination of these two. So the green, light green bar is at least one dose, and then the dark green, which is tough to see behind the window here, are citizens that are fully vaccinated. So the numbers that I think you should really pay attention to: at least one dose in the United States, 38%, fully vaccinated, 27%, and these numbers are going up by approximately 0.5% per day. Now we switch to the UK. They have almost 50% of their population with at least one dose. And then somewhat surprisingly, only 15 that have been fully vaccinated. But we've seen that even one dose can be fairly effective in preventing significant or severe symptoms of the virus. So now you go to the bottom here, and what you see is the actual case numbers over that time frame. So the US had a large peak over the Thanksgiving and Christmas holiday, large drop off, and then we've leveled off somewhat. So if you compare that to the United Kingdom, they've had a similar spike, large drop off, and their numbers continue to go down. So what we can see here is that in countries that are doing an effective job in distributing the vaccine and getting it out there, we're seeing case numbers either level or go down. I think that's going to be important going forward, as we're going to need that to continue this reopening and to have it be a more permanent reopening. Now, in comparison, we see both an emerging market country and then in a country in Europe that you'd think has a pretty robust infrastructure to distribute the vaccine, but for some reason, it just hasn't worked out as well. So the first country here is India. So very populous country, not the best medical infrastructure and the ability to distribute the vaccine on a widespread basis. So what you see in India is you only have 8% of the population that's been vaccinated and only 1.3% that's been fully vaccinated. Now, what's going on in terms of cases? Well, you've probably seen India in the news as their case numbers have absolutely exploded, almost north of 300,000 cases daily as of yesterday, and this was printed a few days ago. Now we look at Germany. Germany is one of the most developed countries in Europe, has one of the most robust medical infrastructures. And what we see here, 19.8% have received at least one dose, and then 6.7% of the population has been vaccinated. So those are pretty low numbers compared to the previous charts. What has happened to cases? You've seen cases come back up. Granted, there's been a little bit of a leveling, but the case counts are almost as high as they were back in the initial spike in the late fall and early winter. So how does that theme translate into other parts of the US economy? So we've seen these charts before. This is hotel occupancy rate by week of the year. So the blue line up here denotes what the median occupancy has been from the year 2000 all the way up to 2020. You have this dotted line as 2009, which denotes the previous worst year in history for hotel occupancy, and that was during the Great Financial Crisis. And then here, this black line, you've got 2020. So it's very clear to see when COVID started, the line was going right with the median. We have this huge drop off, a little bit of a recovery level, and then we fall out again. But look at the 2021 line. So we see a good pattern of upward movement in hotel occupancy as people are more willing to go out, to travel, and to stay in a hotel. So the plan is that this will continue to move higher until it meets up with this blue line for hotel occupancy. Another stat that we've looked at before, TSA checkpoint. So basically airline travel. And same patterns emerge. You get 2019, the year before COVID. So you have roughly 2 to 2.5 million people going through airports on a daily basis. Then you have 2020, huge drop off. And now in 2021, we're starting to see this red line come back up. We're starting to see people willing to travel and kind of go about their businesses as they have before. So we're going to continue to pay attention to the vaccine rates and the case counts, because that, I think, is a critical linchpin in getting us to the point where the economy continues to heal and has a more quote unquote permanent reopening. Whereas in the international space, we're seeing some uneven vaccine distribution, and it's causing a little bit of headwinds for the international space, particularly the emerging markets. So in terms of return, and we'll look at this in a little bit, we had a very good return profile for international at the end of last year, but it certainly leveled off as we moved through the past month and weeks. So Casey, this question asks, what do these two have in common? First blush, I would look at this and say absolutely nothing.
Yeah, I don't know if Alan Greenspan's ever scored 35 points or 50 points in a basketball game or not, but I'll give you a hint. Michael Jordan is holding the pair. Yes, we are talking about underwear. So what is the connection to Alan Greenspan? Well, it's the men's underwear index and what underwear says about the economy. In the 1970s, when Alan Greenspan, the former chairman of the Federal Reserve, he was running his own economic consulting firm, and he said that he looked at sales of men's underwear as an economic indicator. Underwear sales are normally stable, but dip when people are cutting back spending. So his theory was, you don't see underwear. The spending on men's underwear is going to be the first discretionary item to go. And when people are feeling confident, they spend more, and hence underwear sales increase. So let's look at the tape and see if this theory bears fruit. So what we're looking at is a stock chart of Hanes Brands. So there's the connection to Michael Jordan. He's been a spokesperson for Hanes Brands for several years. On the bottom left of the chart, the line you see is the price of Hanes Brands right at the time of the presidential election. It was just under $13 a share. And then a few days after the election, news of the success of the COVID vaccine broke. And then you start to see the stock climb in the next few months, up to $15, $16 range. Then you're going to see a sizable jump in the stock price in February, right after the news story that the stimulus relief package, it was approved by the House Ways and Means Committee, setting it up for a vote in the House. So with the likelihood of more stimulus coming, the price of Hanes Brand stock jumped with the anticipation of sales increasing. So I'm either going to put this in the camp of either Alan Greenspan's underwear index was spot on, or we have an example of confirmation bias, where you seek information to support a belief, but I'm not going to question Alan Greenspan's wisdom here. So, we're coming off a very strong year for stocks. And a question we've received from many of our clients is, what comes next for the stock market going forward after such a strong rebound in stock prices? It's understandable that many investors, they're worried these gains, they came too far, too fast, but the ingredients are there for the bull market to continue. You've got history provides a very consistent message for the second year. It's smaller market gains, stronger earnings, and economic growth. Now, in the last year was that first year we experienced the bull market, we saw stock prices move up faster than earnings. So this relationship of prices relative to earnings is called PE ratios. Those climbed higher, mean that stocks became more expensive. Now, in the second year of a bull market, it's defined more by earnings growing faster than stock prices. But you can have the P and the E, and that PE ratio both can go up, but the expectation is that earnings will grow at a faster pace than stock prices. And this would help ease the concern that stocks are a bit overvalued. So if you have an earnings resurgence, it should be a tailwind for the bull market. It'll compress PEs. Short term, though, the risks are we've got excessive optimism, near record valuations. But when you go back in history now, let's look at the bottom part of this chart. When you look at stock price returns dating back to 1950, you can look at some of the data, see how stocks performed after you've had a 50% move or more. And so we reviewed those returns over those rolling 12-month periods. And when you look at the next 1 year, 3 year, and 5 year time periods, it's not surprising that the 1 year following such a big year would drop off a bit. That may come in the form of low returns or possibly slightly negative, as we've seen in history. However, the further you go out, the better the returns. So there wasn't a single 3 year period following a 12-month gain of 50% or more that showed a negative return. And there's only one 5 year period with a loss. And the average of those numbers that we're looking at over the 3 and 5 year periods, it's 7% over the 3 year, 11% over the 5 year, and it didn't include dividends. So that would have even boosted these numbers even more. So for solid positive returns to play out, earnings growth is going to have to be strong. So Doug, what's the outlook for earnings?
So the outlook is very, very optimistic. So what we have here is Jerry Maguire saying, show me the money, because that is basically what the analysts are projecting in terms of earnings growth. So now you have to remember that when they make these assumptions, they're coming off of presumably low levels from last year when things kind of bottomed out. But these are very, very large numbers. So for the first quarter, you have S&P 500 companies so far that have reported earnings of approximately 30% and a 7% growth in revenue. Now, we're maybe a little bit before halfway through earnings season, so that number could adjust. But as of now, that's a large number in earnings growth. So looking forward, the second quarter analysts are projecting 54% equity growth. For the third quarter, 20%. For the fourth quarter, 15%. And then for the entire year of 2021, that blends to be approximately 27.9%. I believe that would be the highest growth year since 2010, which makes sense because if you remember 2010, that was the year that we were kind of coming out of the great financial crisis, the Great Recession. So the comparisons to basically basement level earnings were much higher. But one of the things that we had on the previous slide was this idea that in the second year of a bull market that you can see PEs contract. So what happens is you get this blast in earnings growth. And then the other side of that is that prices either drop or they just stay the same. So what happens is the P doesn't move, but the earnings go up. So what happens is you essentially get a PE contraction. And we think that is certainly possible in a scenario that we're seeing right now in the market. So how do returns look year to date? We've talked a lot about value. We've talked a lot about small cap. We've talked a lot about growth. And then we've talked a lot about just broad market in general and even international to a certain extent. So year to date, up here, we've got the iShares value factor. So we've talked a lot about allocating money towards value with the idea that the economy is going to continue to grow. We're going to see the possibility of inflation go up and the possibility of rates moving higher. which historically has benefited value assets. So far, that has been the top performer year to date. Then we move down here to the Russell 2000, which is simply small cap, broad market here. And then you have both growth and international at the bottom. So one thing to point out, though, is all these returns are still very good. And we're going to kind of get into expectations here in a little bit. But one thing to notice is that since I think it was around March 8th or 9th, you had the trajectory that we saw for interest rates kind of level off and come back down a little bit. And since then, you've seen a little bit of change in the pattern of returns. So you've seen value level off, you've seen small cap coming down, while you've had the market continuing to go up, you've had international go sideways, but really you've had a growth resurgence right here. And what we've seen is these kind of daily, trading kind of trade-offs, so to speak, between days when rates go down, growth does really well. Days when rates go up, value does really well. So a lot of this is tied to COVID cases or economic data, but we seem to be in a very back and forth environment right now, where one day value takes the leadership, one day growth takes the leadership, one day rates move up, one day rates move down. Now, that's not abnormal when you're seeing some of these longer term trends, which I certainly think, and we've mentioned this before, that we're starting to see the trend of value outperforming growth. But along the way, you're going to have some of these periods where you kind of have counter rallies to the main trend, so to speak. So we don't necessarily think that this is a change in leadership, but it's certainly not surprising to see growth gain some ground against value and small cap over the past few weeks. Now, you've seen this chart before. This is a very long-term chart, shows the trend line of large cap growth performance relative to large cap value performance. So we start all the way up here. When the line is moving down and we're seeing these red bars, that simply means that large cap growth has outperformed large cap value. So this goes all the way back to 1930. And since then, we've had a very long, significant trend of growth outperforming value. You've had a few periods where you've seen reversals here. But for the most part, it's been a growth market going all the way back to the 30s. Now, I'm sorry, I've kind of got this backwards here. The red bars are actually when growth underperforms value. So excuse me. So this has been a value trend for quite a while. You see the spike here when large cap growth outperformed right around the tech bubble. Tech bubble blows up, value comes back. And then for the past, I would say 15 years, you've seen a resurgence in growth up until this point that we think is maybe the pivot or inflection point that we're going to see this start to turn down. Now, one of the questions we get a lot is, how much further does this have to run, since value's done really well versus growth recently? Well, you look at this chart and you can see fairly clearly that we've moved quite a bit, but we still have a long way to go, or the potential for a long way to go to kind of fall into the average of some of these timeframes, which can be decades long. So Fed Chair Powell was on 60 Minutes earlier this month, and two of the quotes that came out of that interview, I think, are worth discussing. So the first was, it's highly unlikely that the Fed would raise interest rates this year, okay? But in that same interview, he went on to say, we feel like we're at a place where the economy is about to start growing much more quickly and job creation coming in much more quickly. So it seems like these are kind of paradox statements, because if they believe the economy is going to do well and jobs are going to come back, their stated kind of mandate is to have full employment and keep rates somewhat stable. But historically, when inflation moves higher, the Fed has had to act in an almost, what would you call it, Casey, a preemptive manner. But now the language around which they're acting has kind of shifted, Casey. Would you not agree?
Yeah, it's and I wonder about that, Doug, because 40 years ago when the Fed was under Paul Volcker, at that point in time, you almost had the Fed operated in a form of secrecy in some ways. They gave you the rate decision. They gave you very little information about what was to come, and sometimes they would continue to cut rates, and then they might increase rates, and you didn't have all this transparency and forward guidance. And it seems like this trend over the years that you've had from Greenspan to Bernanke to Yellen now to Jerome Powell has been more of so much transparency that are they trying to reduce uncertainty and calm the markets? If I look at the data in the last 20 to 25 years, it seems like we've had more volatility. And if you give people too much information, it seems like it looks for the environment for people to take on more risk. And that's what I wonder. So how is the Fed going to back off at some point in time and say, we're going to walk over and grab the punch bowl and bring it and walk away, and things are going to be or unwind okay? How are they going to do that, Doug?
Yeah, it's hard to say. It feels like right now that the Fed is kind of continuing to play chicken with the market. Since QE started, there's only been one instance where they've actually tried to raise rates. That was at the end of 2018. I think they got close to 2% on the discount rate, which is the shorter term rate. And it was a disaster because it got to a certain point, the market said, we can't handle this, and promptly sold off, I believe around 20%. And very quickly after that, they backpedaled, took rates back down to zero, and off we went. So there is a large contingency of people who believe that the Fed will never be able to raise rates again, at least without causing major disruption in the market. So if you take the Fed for their word, they're telling you that they're not going to raise rates this year, even though they expect the economy to grow more quickly and for jobs to come back. So for now, I think they've got some room, but it's interesting language and will be very, very telling going forward. I think it'll also be interesting to see how the bond market reacts to this. And we'll look at rates here in a second, but as we look at jobs, this is the comparison with the latest recession that we saw versus all the other major recessions since World War II. And the other one that obviously comes to mind is the 2007 recession, which wasn't as deep as this one, but it certainly took much, much longer than all the other ones to get back to full employment. So this one was extremely steep. And we've had good progress, but we're still a long, long way back to where we could be. So if we do take the Fed at their word, maybe they're saying, hey, we're looking at this same chart and we're not going to, I think the exact quote is, we're not going to thinking about raising rates right now. And they may need to see this job number way up here. So I think the point to take away is that, we've had a lot of questions about rates moving higher and inflation moving higher. And what the Fed is saying that they're willing to kind of be a little bit more reactionary to this than they have in the past. So I think we can expect a moderate level of inflation if everything plays out according to plan. If you just look at what the rate complex looks like over the past 5 years, you can clearly see where both the 10-year and then in orange, and then the 10-2 Treasury spread follows right along with that, because the 2-year Treasury has basically just been pinned to the floor. And then you have the market implied inflation rate here at 2%. So rates shot up quite a bit at the beginning of the year. We've leveled off certainly since then, and we came back from a high of 1.8 down to 1.6 when we printed this. I believe that today, last I looked, we were close to 156, 157 on the 10-year. But you think about it, if the 10-year Treasury goes up 5 basis points a month for the rest of the year, that puts us at 2%. And that's not, an outrageous number, though. I think some people would look at that and be scared. Now, looking at just commodities in general, we see this top chart here the commodity industrial input, so things like lumber, metals, things like that, it's pretty clear that the prices of those inputs are going up, and they're going up quickly. On the flip side, you've got food and beverage, same thing, going up. So the Fed can sit and kind of say, hey, CPI is benign or non-existent, but when we look at what's going on in terms of raw material inflation, it's pretty clear that it's happening, and we're seeing it take place right in front of our eyes. So how has all this affected bond returns? Well, we've got a lot of questions about that. And you can see this has been kind of a tough year for the bond market, so to speak. So there's a few lines on here. I'll try my best to point all these out. But down here, you have a security called Zeros. That's the ticker, which is basically the PIMCO zero duration coupon, or I'm sorry, zero coupon ETF. So zero coupon bond basically has no interest payments. You buy it at a discount and matures to par. And really all the interest payments are kind of phantom. But what's unique about zero coupon bonds is that they have the highest duration of any fixed income security. And then duration is just a fancy way to describe the relationship between how interest rate movements affect bond prices. So if you have a duration of 5, for instance, rates go up 1%, the price of that bond comes down approximately 5%. So these zero coupon bonds have durations in the 20s. So obviously they've been hit pretty significantly, being down almost 16%. Then you kind of start to move up. You have your 7 to 10 year treasury bond right around here, down almost 4.5 to 5%. You've got your the Barclays Ag, which is basically the S&P 500 for bonds, with a duration of around 5 or 6, down a little over 2.5% here. Then you've got things like the 1 to 3 year treasury bond, which has very low duration, still slightly negative for the year. And the only thing that you see positive in the fixed income world right now is you're looking at the Invesco high yield bond, which has essentially been a more of a kind of statement on risk taking, so to speak. So the bond world has certainly been a challenging place, and we've continued to try to make portfolio adjustments to address those concerns. Now, lastly, one of the things that we've seen pop up this year is that as kind of outlandish returns have been condensed into a very small window, clients' expectations have shifted a little bit. And there's this concept called hyperbolic discounting. It's a behavioral finance concept. And if you look here, it's the idea that we want instant gratification. So we want something that we can have now instead of waiting for a better outcome far in the future, even though we can get that outcome. So this chart here, would you rather have $50 now, or would you rather have $100 in 1 year? So the devil on this stick figure shoulder is saying, we want $50 now. The angel's saying, we want $100 in 1 year. You can also see here, this is another way to look at it. What do we want? We want instant gratification. When do we want it? We want it now. So nowadays, think of how many times you check your statement, your account balance in a month. Probably 30. Probably do it once a day now that we have access to it. And as we look at some of the returns that we've seen, it feels like investors are, I guess, reaching for some of these outlandish returns, feeling like they need that instant gratification, almost a fear of missing out, instead of kind of sticking with tried and true methods that they know over time will work, but it's just not as exciting. So, Casey, who better to teach us a lesson about long-term investing, or kind of having a longer-term time horizon, than our red-eyed friend, the cicada?
Yes. So what does instant gratification mean to a cicada? When you're waiting 17 years, yes, the cicadas, they will be with us soon. And they were last with us back in 2004. What has changed in your life since 2004? I thought it would be good to reflect a bit on what was going on in culture and the markets and compare 2004 to 2021. So it's amazing the reaction of your brain when you see this slide. Blockbuster was the place to go for movie rentals. Blockbuster was at its peak back in 2004 with more than 9,000 stores worldwide and revenues of more than 5.9 billion. Small fact, unknown a little bit, Netflix tried to sell to Blockbuster for 50 million. They said no. Now you can stream major motion picture movies and gobs of original content in your living room today, and you've got many choices. So when we look now at the S&P 500, the top 10 companies in the S&P have really changed over the course of time. So the top 10 are companies that are referred to as ranked by size by market capitalization. So number one back in 2004, GE. It was number one or in the top 10, in fact, from 1980 to 2007. It's now ranked number 69 out of the S&P 500. AIG, it almost didn't exist in recent years until it received a lifeline from the government. It ranks number 185 today. So only two stocks from 2004 remain in the top 10 today. It's difficult to stay at the top. Times change. It's very easy for people to get emotionally attached to a stock. So as we've seen over time, there's no sacred company. It's important to be diversified. Much has changed. And in many cases, this change was substantial, but the changes didn't happen overnight. So if we go to the next slide, here's some additional market stats. So interesting enough, when you look at the top of the title of each of these columns, back in 2004, that's when we had the last SARS case, which is a form of a COVID virus. So how ironic is that? The S&P and the Dow, they've risen 3 times to 4 times from where they were back in 2004 to today. So it's easy to be focused on what the market does day to day, that we lose focus of the long term. And these numbers really help provide context. But I also appreciate that viewing long-term numbers, you lose sight of the many bouts of volatility that are challenging to investors along the way. Now, it's interesting when you look at the 10-year Treasury rate, it's kind of a reverse of sorts here that's happened for interest rates. The 10-year Treasury rate dropped from 4.5% back in 2004 to 1.57% today. If you're a retiree, your income checks are decreased by 65% over time. Now, you couldn't lose your principal. You're guaranteed to receive your principal back, but there's been a price for safety and the security of your principal. The income you received was cut and couldn't keep up with inflation. Now, I'm going to skip that SPY dividend. I'm going to come back to that one, but that bottom chart you see says buying power. It's decreased with inflation. You need $1.40 today to buy the same goods and services you could buy with the dollar back in 2004. So inflation's like termites. They eat at your foundation of your finances, and inflation's a slow process. It creeps, it builds over time. You don't notice it so much year to year, but the compounding effect of inflation is damaging to your finances. And your income needs to be able to grow and stay ahead of inflation. So how can you stay ahead of inflation in retirement? That leads us back to what I skipped earlier. Maybe the most important item on this page that I skipped is that SPY dividend number. Those are dividend payments you would have received back in 2004, 39 cents, and today, $1.27, which is coming from the S&P 500 ETF security that trades under the symbol SPY. That's a substantial increase over those 17 years. So the focus for most people when we look at this page is on the market indices. And if you're an investor in retirement, the most important thing to you is to have income you can depend on, and it's growing faster than inflation. Those are attributes of a growing dividend strategy. We'll take a deeper dive at a future webinar. We'll talk more about dividend growth investing. One other quick stat on this page I want to make sure that I don't miss. In 2004, only 8% of stocks had a higher dividend yield than the 10-year Treasury. Today, that number is 48%. That tells you how low interest rates are today, but also how attractive the environment really is for dividend-paying stocks. So, before we were looking at the picture of the cicadas and the 17-year view into the picture. And it's odd to think of cicadas as some form of a signpost on our journey, but it's good to reflect. And what's changed for you in the last 17 years. You think about where you've lived over that period of time. What stage of life were you in 17 years ago? Were you raising a family? Or were you in your peak earning years? Or were you on the cusp of retirement? If you've ever had kids, you feel like you blink and suddenly they're graduating from high school. And where did the time go? You're now 17 to 18 years older. So what's changed in your life? Are you where you wanted or expected to be now? Did you plan? So it's fun to review these two slides we cover with how things have changed over time, but it doesn't mean anything without a plan. I've been with HCM now for over 20 years, and I've had the fortune to see how clients' plans have evolved. It's extremely rewarding to reflect on the many families that have invited HCM to be a part of their life, whether they're a new client or been with us for a few years, a few decades. Yesterday, I happened to speak to a family and their son's heading to Indiana University this fall. We've discussed, we've mapped out a plan, we've invested along the way, they're ready to go, the funds are in place. 17 years ago, I can think of a family, actually an individual, a gentleman I started to work with. He was back in his early 50s and he was recently divorced. He was looking to recalibrate, map out a plan for retirement. As time went on, another partner came into the scene and they were remarried. Goals change, new goals are added. To move south to a new home in retirement. Life intervened and his mom needed some help. Today, they're retired, living in their new home south. COVID's brought some changes for some of our clients. They've decided that they'd like to live in a different part of the country. Plans change. Another discussion coming soon this weekend with someone. They're going to have to get on the airplane starting this summer and travel almost on a weekly basis for their job. And they don't want to do the extensive travel anymore. They'd like to be able to retire if they can. The good news is it looks like they can. They've done a great job of executing their plan all along the way. So life happens. It may have been a loss of the job or a loss of the business or selling the business, career change, entering back into the workforce to early retirement or postponing retirement, the passing of a spouse, celebrating a new child or grandchild, from a growing family to peak earning years to retirement to fulfillment and quality of life to legacy planning. Rarely does life play out the way we think. The success comes from the process of planning and then revisiting the plan and adjusting the plan along the way. So the HCM clients that are watching, thank you for placing your trust and confidence in us. And as Mike says, if we can be of help to you, a family member or a friend, please reach out to us. We would be honored.
Thank you, Casey. So let's get to some questions here. We've got a few that have come in. So the first one is Bitcoin or Dogecoin a part of anyone's planning process right now? What would you say to that?
Boy, Doug, I think the challenge with any of these currencies is you've seen swings at time, whether it's a couple of days, a week, or even a weekend, where these prices increase by 25 and 30% or plummet by 25 or 30%. So in the vein of making sure that we can ensure that people are financially secure in retirement, from a volatility perspective, that's too much volatility. If somebody wanted to, maybe with a small piece of their money, that if something happened to it and they were to lose the majority of those funds, then by all means, I think certainly put a few dollars at play and see what happens. I think there's not a lot of regulation that's surrounding these currencies, and they're very attractive. But I think they're very, very difficult to get your hands around and really understanding how these operate. And there's going to be some winners, and there's going to be a lot of losers, those too. And these things tend to play out over time.
Yeah, I think when you're talking about something like Bitcoin, it does have a little momentum behind it in terms of adoption. So you've got businesses, individuals. Some people will actually take it as a form of payment. You've had some institutional interest in actually investing in Bitcoin. But again, you talk about having swings of 5, 10, 15, 20% overnight. that doesn't necessarily lend itself to being a currency, so to speak. So I think right now it's probably still in the speculative stage, but many people look at it as a possible inflation hedge in the future. So certainly an interesting concept that we'll continue to keep our eye on. As for Doge, I mean, Dogecoin was made as a joke, almost to make fun of other cryptocurrencies, and as kind of a sign of the times. You've had this mass adoption and flood of money go into it. The price just shot up, but you know, in terms of just pure speculation, I would say that it certainly falls under that camp, and we would certainly not endorse or recommend anybody investing money into something like that they, you know, were not able to lose 100%. Next question. So how does the market look historically versus GDP, or you know, is the market valuation trending with GDP? So I've seen this chart floating around. I wish I had it in front of me. I will try to send it out after this, but what you've seen is, you know, one of Warren Buffett's kind of favorite indicators is market valuation to GDP. And right now that number is brushing up against levels that we saw during the tech bubble of 2000. So you've got a lot of people kind of concerned about that as an indicator of trouble ahead. You know, one thing with that I think that's interesting is that you've had the market run up, but you also have to remember GDP in I think it was the second or third quarter of last year, fell by 35%, or at least the growth number did. So that's a pretty big number, and we're still trying to recover out of that. But if you just looked at valuation to GDP, you might look at that and draw a conclusion that the current trajectory is not sustainable. So either the market valuation would have to come down to meet GDP, or GDP would need to come up to meet the market valuation. So it doesn't necessarily have to be a scenario where you're saying, okay, this dislocation is going to lead to a crash or something really bad. But historically, you would see those two things trading in a little bit closer range than what they are now. Casey, do you have anything to add on that?
No, Doug. I've seen that chart circulating around, and I would agree with that.
Okay, great. So I think we have time for one more question that has come in. Do we have any opinion on the capital gain tax headline that just was released this afternoon? I've only had limited time to look at it. I think what I've read is that if you live in California or New York and you make over $1 million, it's not going to be a great situation for you. You're going to be paying, you know, with everything, state, you know, capital gain, Obamacare tax, all that stuff. You could see rates approaching 50% for those folks. But it looks like anybody who's not making $1 million or more, that the capital gains rate will probably stay the way it is. And again, it's very early in the process here. You know, this may not even pass in its current iteration. But like I said, I only had limited time to look at it. Casey, were you able to glean anything from what you saw?
Yeah, the same thing. I just saw the headline and had limited time to view it as well. And but I think from what I saw, again, in the limited amount of time, I think it's similar to what has been thrown out there of this possibility of that $1 million line. And there's a little bit of feeling of, you know, people won't blink as much if you quote tax the rich. But I think a lot of people have questions of, is that just the beginning, and does that line continue to move down over time? And certainly, you know, we don't know the answers to that. But you know, the concern some clients have expressed is, well, are they going to start increasing my capital gains tax rate? And we'll see. I think some people feel like if I have assets, and that means that you have wealth, and if that's the case, rates may go up, and it may. I mean, rates today, if your income as a married couple together between all sources is under $105,000 to $108,000 between all sources, capital gains and dividends actually aren't even taxed. So that's a pretty good break. And then anything above that's taxed at a 15% tax rate, and it can increase a little bit more from there. So it's a fairly low tax rate now already. So in time, certainly you could see those numbers increasing a bit. But I think some people are concerned as that line continue to move down.
Yeah, and one other thing that I saw was the possibility of taking the step up away. So if you have somebody pass away, they leave you money. Right now, it basically the cost basis steps up to what the market value is in the date of death. But there's some chatter that might be taken away, which would obviously change people's tax burdens on inherited assets fairly substantially in some cases.
Yeah, that would be a substantial hit and really change estate planning. And that's something that since 2011, brokerage firms have been gathering now and making it mandatory that they keep cost basis data. So they've been able to build this now over time. So they have that information. And so it's going to make it much easier for them to implement. But still, I think it would be very difficult to implement today. There's an awful lot of securities out there that people still don't have a sense of what that basis is for stocks that have been purchased a long time ago. But that would be a big sting to people in their estate planning.
Yeah. Well, that's all the questions on here. So if you want to take us out, go ahead.
Well, thank you very much for being with us today. And we'll look forward to speaking with you next month on the webinar. I do not have the date. I think it's typically the third Thursday of the month, but stay tuned. Doug, do you know the date?
I don't know the date off the top of my head, but usually it's the third Thursday of the month. So we've tried to keep that fairly consistent. And as always, if something pops up in the interim that we feel is needs to be addressed at that time, we can schedule inside of that. But we'll send those dates out as soon as we have them.
Thank you, everybody.
Thank you.